Hi everyone, I'm Paul and welcome to my market update for the 23rd of September 2022. The FOMC met recently and decided to increase interest rates by 75 basis points. Now, for those of you that have been watching my updates, you'll know that this is exactly what I was expecting. And to be honest, I wouldn't have been surprised if that actually increased by 100 basis points. But the thing that's been quite surprising is how non-responsive the market's been to this announcement and the surrounding statements by the Fed. Jerome Powell continues to be super clear about the Fed's intention about getting inflation back to target. And as he stated many times during his speech and in lots of the correspondence from various commentators afterwards, there's a lot more pain to come. From my reading of the meeting, there was nothing positive in any of the statements made by Jerome Powell, and the revisions to forecasts made by Powell and the Fed I think were really illuminating. We may just have moved into the phase where bad news is actually bad news for markets now. Before we dig into today's charts, please make sure you like this video because that helps other people to find it. And if you haven't already, please make sure you subscribe to my channel and turn on notifications so that you never miss an update. Now let's jump into today's video. So as I mentioned at the beginning of the video, the Fed in their September meeting has raised rates by 75 basis points. And not only is that a sizable increase on its own, it's actually the third straight meeting where they've increased interest rates. And so remarkably, that means that the Fed has actually increased interest rates this year so far by 300 basis points. And so these increases by the Fed are unprecedented for two reasons. One, we have 300 basis points of increase in one given calendar year, which is quite remarkable in itself. But the other thing that's quite remarkable is just how rapid these increases have been. Now, to top all of that off, not only have we had an unprecedented increase in interest rates already, but we should expect that the Fed's going to increase the interest rates by another 125 basis points this year, with a potential 75 basis point hike in November and then another 50 in December. So these really are remarkable times. So this quote from Jerome Powell after the interest rate announcement just really succinctly sums up what I think the Fed is just all about at the moment. So he said, "We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet." So the combination of QT, which is quantitative tightening, which I've talked about in previous updates, and the interest rate increases is going to continue to put downward pressure on the money supply. And so as long as the money supply is going down, that's basically going to put downward pressure on risk assets. And so one of the things I think we really need to keep in mind is because these rate rises have been, quite dramatic and been very rapid, we haven't actually seen the effect of those previous hikes actually make their way into the real economy just yet. And how I'd anticipate we'll see this manifesting in the real economy is through a downward pressure on earnings. And so with earnings season coming up, I think we'll start to see some misses, and that's going to put pressure on equities and obviously pressure on the stock market more broadly. So I think based on the statements that Jerome Powell's made, not just in this meeting, but at Jackson Hole and before, we should be under no illusion that the Fed is just going to keep hammering away at that 2% inflation target until they reach it, and they're just going to keep pushing until something potentially breaks. And I think one of the things that people just need to keep in mind is that we've never seen a bottom in the stock market as long as the Fed is increasing rates. Now, whilst this situation is fairly unique in terms of we've had, quantitative easing, quantitative tightening, interest rate moves and so on, is we've actually been here before. So in Q4 of 2018, the Fed was actually reducing its balance sheet through QT whilst it was increasing interest rates. Now, this QT by the Fed and the increases in interest rates was so aggressive that a lot of people in the marketplace believed that the Fed had overstepped. And indeed, that certainly seemed like that was the case, because eventually the Fed had to pivot because the markets at that time fell by about another 20% from their already depressed levels. So we've been in this position before, and I think this is the underlying narrative that has kept markets, buoyant, is they're banking really on another Fed pivot. Now, as I've mentioned before, I don't believe a Fed pivot is imminent. I think we're in a very different situation as we were to 2018 with inflation just running out of control. So really, the Fed doesn't have any choice but to pull on that interest rate lever. All right, so let's jump into some charts now, and we'll start with the DXY, or the US dollar currency index, which, as you know if you've watched my updates, it's the chart I look at, and it's the chart that I think everyone should be looking at if you're trading risk assets. So this run on the DXY has been super strong. I've been talking about it for a long time, and you can just see the power of this move here, and there just really doesn't appear to be any end to this rally in sight. So we've already pretty much gotten to close to the target that I was picking quite early on. So we broke through this buy side liquidity. You'll recall from earlier updates, I talked about this swing low and using that as kind of like a first target. So you can see we've already breached that. We're now into this fair value gap, which I've marked out. Now I chose this fair value gap very early on because if you take the range of this move, which broke market structure, so broke market structure here, you run your fib at 50% levels there, and you've got a fair value gap right there. So if we draw that out, you can see we're just starting to poke into that. Now, based on the strength of the rally, it's quite possible we might trade through that. We're certainly going to go deep into it. Now, we might need to see some more price action to see if we consolidate around that level. That would probably be the first good sign that we're going to get that we might see the DXY start to weaken, and then there could be a focus back to risk assets. But there's no telling what will happen. Just given the strength of this rally, we could easily take out these highs here. A little while ago, I wouldn't have thought that's possible, but just considering how bad the macro is and just how long I think rates are going to be high for, it's quite possible we're going to see the DXY, take out these highs over here. And we don't really have to look too far for confluence. So if we look at the euro or the euro US dollar, you can just see, the inverse of that relationship. Keep in mind that the euro is about 50% of the DXY. So you can just see how strong this move has been on the euro. It's just been one-way traffic down. You can see we're approaching this sell side liquidity relative equal lows down here. And really, again, I think the only place we'll see a little bit of resistance as we come into this fair value gap right all the way down here. So that's quite a long way to go. Talking about 92, we're at 97 now. It wasn't that long ago that the idea of going below parity, would have seemed like crazy talk. So, this is really an unprecedented move. Again, just given the strength of this fall, I just don't see it stopping anytime soon. We're certainly going to, test and go into this fair value gap down here. But that's not to say that we couldn't, test these lows down here into the future, just depending on what the macro presents us, coming into the end of this year and the beginning of the new year. And so what does all that mean for risk assets? So if we look at our traditional markets first, we'll just have a look at the S&P as an example of that. You can see, and this is a monthly chart, that it's looking pretty sick. So we obviously had this fairly strong move. You can see we had this big up close candle, and it's just been completely reversed by these two previous monthly candles here. And you can just see with these wicks, we've taken out these highs. So we've taken out the liquidity at these levels. We've come crashing back through, wicked again. And now really it's the liquidity at these lows here that appear to be targeted. And really, I think the first stop is going to be somewhere down in this region here, right around that 3,400 level. We have this big order block here. And even if you just eye test, you can see this level here from, the pre-COVID highs across. You can just see that's a consistent level where price has, gone above and under and just spent a bit of time there. So it seems quite possible that we could come down and test the base of that order block before we potentially, get some consolidation and then move one way or the other. And if we zoom into our daily chart, it doesn't really look much better. You can see, we traded down, we created this low here, we traded up through, we took out these relative equal highs, and then we've traded down pretty much ever since. So you can see we painted these fair value gaps on the way down. We had this move here, which basically went right up into this top fair value gap. I talked about this at the time. This would have been a really great trade for anyone who was on it. I myself wasn't at the time, just because I wasn't taking on any new positions. And you can see we just sliced straight through those fair value gaps, took out this sell side liquidity, and again, it's been pretty much one-way traffic since we traded right down into this bearish fair value gap, which I talked about in a previous update, but we didn't really stay there for long. And you can see we're now attacking this sell side liquidity here, and really the next draw on liquidity seems most likely to be down here. And if we zoom back out, you can see that order block that we were talking about on the monthly chart, and this is our pre-COVID top just here. There's actually a bullish fair value gap just in here on the daily chart, and again I found that by running my fib from the low. I'll just zoom in, the low to the high of that move. This is the one that broke market structure here. So you can see as we pulled out, this is the move that broke market structure. If we take the 50% level, there's our bullish fair value gap right there. You can see that coincides quite neatly with that pre-COVID high, and it's all sitting inside that order block. So my expectation is that's a level that will get challenged, and we could quite see the market start to bottom there. I think there'd be a fair bit of natural buying at around that level, but again, that's quite a fair way from where we are at the moment. That's over 300 points from where we are right now. And if we move over to crypto now, looking specifically at Bitcoin, you can see this chart just doesn't look any better than the S&P. So we've really had one-way traffic since the highs from late last year, and we've had a little bit of consolidation around these all-time highs just here. So you can see we wicked into them, we've traded back above, we've traded back down to them, and now we've traded through them. So you can see this down close candle that we're forming now on this monthly has this long wick, and we're now poking our way through that all-time high. So I think that's a really critical level, and where I feel that the market has an opportunity to start consolidating again is down on this monthly fair value gap just down here, which takes us down into that $12,000 territory, which feels like quite a long way from where we are right now. Now, if we zoom into our weekly chart, you can see why we've been consolidating around these levels for the last couple of months. So we've had that all-time high, so that's acted like a bit of a magnet where the market sort of mean reversed and just bounced around it. But there's also been this bullish fair value gap just here, and you can see the market's traded in and around it. We may have deviated above it a little bit, but now we've come back into it, and now we're starting to break through. And so from our weekly chart, you can see even eyeballing that if we lose this level, which is actually relative equal lows, this would actually be a really significant level. And I think if we lost that, then it seems almost certain that we're going to come down and test into this range. And you can just see from where we are right now, even though we're talking about that weekly chart, the most likely draw in liquidity is most likely to be down towards this sell side liquidity, relative equal lows. And so I think the combination of taking out that June low and losing that all-time high is going to send the market definitively lower. So if we zoom in now finally to our daily chart, you can see how we're just really holding on to this all-time high level. So we've just sort of deviated above it, we're now underneath. We've retested this sell side liquidity down here, and there's been a lot of volatility around that interest rate announcement by the Fed. So you can see just here, we wicked down, we traded right back up, we wicked up and above and below, and then had another big up close candle before now starting to pull back again. So as we mentioned when we were discussing the weekly chart, you can see this bullish fair value gap that we've traded in and around for this whole few months. We've deviated above it, we're now starting to break below it. And this is that sell side liquidity, these relative equal lows, that is most likely to now going to be the draw on liquidity. So you can see even on the daily chart just how important these levels are. So this all-time high and these relative equal lows down here, that if we lose these levels, there's really not much going to hold the market up until we get down to that sort of 12,000 to 14,000 level. Thanks for watching today's market update. I hope you enjoyed it, and I hope you more importantly got something out of it. If you did, please like this video because that helps other people to find it. And if you've been enjoying my content, make sure you subscribe to my channel and turn on notifications so that you never miss an update. Thanks for watching, and I hope to see you next time.